Welcome all back to the pod. I think it's 3 weeks in a row now, and we are up to episode 59. If
Yep.
I am, accurate, Arnie.
Yep, spot on.
No Jolly today. Big Jolly's a bit busy, so you got Big Arnie and Brad covering you off. So introductions as usual. Brad Tabone, startup investor and advisor.
Yeah, and Arnie, finance professional.
Finance professional. Bang around. We're going to have a good one today. We were going to cover off looking at the resource super cycle, but how can we cover off resource super cycles when we've got banks failing left, right, and centre? Pretty crazy times out there, and so we're going to do Rivkins, obviously, standard. And we're going to be spending a bit of time today, similar to the episode that we, Arnie and I actually did together as well, explaining the bond situation in the UK.
The UK, the pension funds.
I think it was about 3 months ago, 4 months ago.
Yeah, it was.
Bonds, even though they are boring things, they're back in the spotlight. So we'll be explaining what happened with Silicon Valley Bank, because there's a lot of misinformation, or a lot of, I'll say, misexplanations running around in the corporate media. A lot of standard kind of fear out there, with some good reason, but some of the reasons they're giving out were not so good. And after kind of investigating a little bit more around Silver Lake, which we spoke about on our last episode, and also there was a sneaky little kind of bank that went down, Signature Bank, that no one really kind of saw, which was still huge, and they just kind of snuck it in with the SVB announcement around where they're going to be backing up depositors.
That's so funny, man. Like terrific sneako Signature Bank.
Like they literally just went, we're covering SVB, rah rah. By the way, we've taken control of Signature Bank. Okay, no problems. So before we jump into Rivkins and jump into bank explanations and, of course, quickfire news, Arnie, where can they get us?
You can get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And please leave a like, comment, subscribe, hit the bell, because it helps us. And yeah, we want to help you.
Yeah, no, please help us help you, basically. So first of all, I guess we've got to get Rivkins. And the quote that I've got from Rivkins today, for those that kind of have heard me talk about oil stocks, this is a good one. It is easier to not find oil than to find oil. And for those that kind of follow any sort of oil stocks or investments in general, I think it's a very good kind of frame of mind to be going into investing, and not always going in with the glass half full optimistic view on everything.
Yeah.
Where, traditionally, oil wells have a sub 10% chance of success. So when you drill, and that's why oil exploration costs us money, I personally think is kind of getting on the front foot of saying, like, don't always just think, you're going to hit oil, or the drug on your biomedical kind of thing is going to come through, or the new Facebook Meta player is going to come out. Kind of err on the side of caution sometimes. Anyway,
it reminds me of that famous quote from either Munger or Buffett, maybe both of them at one point in time, have sort of said, like investing or any kind of asset class is like stepping up to the baseball plate, but you have unlimited at bats. Like, you don't need to swing at everything. You wait for the perfect ball and then you smash it. That's what I take from that Rivkins quote. And oil exploration. You and I have been on the receiving end of a few bad experiences with penny stocks, but then when you hit one, it's like, it pays for the rest. So yeah, that's
exactly. I think your words just then were about as good as investment advice as anyone can ever hear. Right.
Yeah,
there.
That's it. You need to have that mindset. You need to constantly reinforce it, because it's so easy to get caught up in short term.
Not to get caught up. And we've been investing for 17 years, 18 years, and I've got to say, I still to this day have to reinforce that. And you just bite the bullet, or on a bad day, you're like, oh, I just want to sell, and just breathe.
Well, that's what you got to do, eh? Yeah, man. There's another. I know we're getting off topic here, but there's another famous quote from one of those two famous investors, which is like, if you can't bear, I'm paraphrasing here, but if you can't bear to see the side of your portfolio down 50%, then you're not made for investing, or something along those lines.
And again, true. Anyway, on to I guess the SVB or Silicon Valley Bank explanation video, and we're going to get our whiteboard up. So I'm just going to share my screen. Let me know if you can see this. Just talking about the news at the moment.
Yep.
So for all those that don't know, and actually cut it out of the last video because at that point in time we're just talking about it on the Friday, and then the weekend was big news, and it kind of changed things a little bit. But
we were all over it though. But yeah, now we
yeah,
just thought we'd wheel it back for a proper episode about it because there's a lot of detail.
yeah. So obviously Silicon Valley Bank, top 20 bank in America. I think it had, in the end, assets circa 150 billion. Correct me if I'm wrong, Arnie. And there was also the UK version of it. So the UK version of it, come Monday, got bought out by HSBC. So the UK government and HSBC have worked together to kind of buy out the UK startups. And Silicon Valley Bank in the US left to fail, but the Fed stepped in with the Treasury to guarantee the deposits in it. So usually they guarantee deposits on accounts up to $250,000, but they've come in and said they're going to cover off all of the deposits in the bank. Now, before we jump into, I guess, the why and etc., Silicon Valley Bank, the reason why it's getting a lot of news, etc., is because there's a lot of senators, there's a lot of specific rich, powerful people in the US that within half an hour of the bank on Friday kind of saying that it's not going to be able to meet things, we're calling out for deposits to be guaranteed, and some of them were saying the bank should be bailed out and the rest of it, because it is used by Silicon Valley. It is used by, we'll discuss it today, by about 50% of all startups in America that get funding from VCs. And so this is an area that obviously I know a bit about, seeing as though when I kind of organised our Series A for Hammertech from an LA-based venture capital firm, Arrowroot. They told us, hey, SVB or First Republic. And, First Republic were a bank that went down 74% over the last couple of days and are in the kind of crosshairs of Moody's at the moment. They got downgraded today, but I mean their stock jumped 55% yesterday, so it's a bit, who knows what's going to happen. But Silicon Valley Bank didn't make it, so I just want to start off. We just want to start off there, but let's go into a bit of a learning session. A whiteboard, Arnie. It's been a while.
The old Canva, what a good tool.
What a tool. So what we're going to do, first of all, is we're going to grab a bit of Silicon Valley Bank. We're going to throw it here. Hi, Silicon Valley Bank. And so this is Silicon Valley Bank, everybody. And how does Silicon Bank make money? So traditional banks make money generally from taking on deposits, lending that money out, and whatever the spread is between their deposit rate, lending rate. Now, they make money other ways. Obviously, there's credit cards, there's bank fees, there's all myriad of things, everybody. But let's just keep it simple. I like keeping things simple. And Silicon Valley Bank got involved in IPOs, venture investments, secondary raises, acquisitions, SPAC, special purpose, something.
Acquisition codes.
Bang. They'll all the rage in 2021 when Chamath made all his money and saying lots of other people's money. But we won't go into SPACs today. We're just kind of talking about they get involved in everything that Silicon Valley does. And when we got told to put our money into Silicon Valley Bank or First Republic, the reason why is because the bankers understand you as startups, supposedly. They understand the kind of language. They understand that you don't make money, that you just burn money on fire. And just the nature of the transactions that you do, they can provide you kind of, they work with companies like Brex around providing you with Visa debit cards that are linked to your bank account and percentage of whatever cash you've got left over. They understand your bank account's generally going down until you do your next round of capital raising. And so, yeah, I mean, Silicon Valley Bank was there, and again, took lots of deposits in, right? There's all this money that's coming in via venture. Every kind of round of capital you do, whether it's a seed round, Series A, B, C, D, etc., etc., etc. Secondary raises. This money's coming into the account. Now, they did struggle to, I guess, lend that money out, because generally startups aren't your typical best recipients of typical banks' loan requirements, i.e., they're losing money, they don't have any assets or little assets. They're kind of the opposite to someone that you want to lend money to. Now, there is venture debt out there, which Silicon Valley Bank did do a little bit of, but generally that's done through more specialized as venture debt funds that are set up for that reason. Now, what does this mean? So this means that generally speaking, we're going to go back to some of our awesome stuff that we had previously for the UK. So today we're going to talk about bonds. Bonds are going to be a big thing. We're going to talk about our little friends, that's me over here, one of these guys, startups. We're laying the groundwork over here. We're going to get some venture, some VCs. This is going to be the VC people over here. Oh, there we go, some VCs. And I think let's start telling the story. So, what happened to Silicon Valley Bank? Well, Silicon Valley Bank, of their deposits, so of their funding, 89% of their funding comes from deposits, and that's deposits are linked to the startup guys. So we'll do that. Startup guys give deposits, and we'll say the venture people that look after the startups tell them to go to the Silicon Valley Bank. So Silicon Valley Bank is loading up with deposits, and let's get our deposits. All right. So here is the deal activity. One second. This is deal activity, and this is deposit growth. All right. Can you see that, Arnie, on your screen?
Yeah, that's looking good, mate.
Awesome. So we've got, at the moment, bottom left, we've got the Silicon Valley Bank before the run. And what this is showing is that, 2018, they were taking in about $50 billion a year. And then, that's climbing. And then, it's climbing in 2020, it's going up to about 100 bill. And it's getting 150 bill. And in 2022, it is up to about 200 billion for those that are listening on the Spotify or on the actual audio podcast version of this. So there's a huge increase from 50 billion up to about 200 billion in deposits per quarter. Now, the majority of this were uninsured deposits because for some reason, and one of the big learnings out of this and one of the big criticisms out of this is what were Silicon Valley startups doing and what were VCs, who traditionally are quite of like hawks of the financial industry, doing, recommending that their clients put 100% of their cash into one financial institution when they know that the bank account is only guaranteed up to $250,000. So that's one criticism. But alas, the deposits grew 4 times the average kind of quarterly income, quarterly intake. And look, the big reason, there's a number of reasons for this. One was around deal activity. So when we look at deal activity graph down here as well, you can start seeing that in, around 20 billion, 40 billion, 50 billion, around 2019. And then in 2020, after the initial crash of Q1, and then 2021, 2022, you can see that there was a massive peak up to about $100 billion a quarter of deal activity in, this is via PitchBook's Venture Monitor. So these are deals. So these are basically venture funds funding new companies or existing companies on new rounds of capital. So we all know that the markets went a little bit crazy in 2020 and 2021 with really cheap cash, lots of PPP loans out there. So that's another reason why, on top of the deal activity, there was lots of money, i.e., Hamatech was a recipient of PPP loans. That's where the government was sending out money to companies like here in Australia per head count to keep staff, basically. And on top of that, you had a lot of money and liquidity in the markets, low interest rates, and record quarters of venture capital flowing through. So at that point in time, there was a lot of money coming through, and that generally would be a good thing, right? But you've got to have somewhere to put all this. So Silicon Valley Bank, for some reason, decided that it was going to put its funds into 10-year bonds.
It's excess funds. So the money that it couldn't lend out fast enough,
Yes.
it was going to put its excess into bonds.
Now, on the bonds side of things, I don't know when it was, but in the US, under community banks, there was two types of, I guess, ways you could hold bonds. So after the government allowed tier one capital, so basically as part of stress tests, community banks stress tests are a little bit different to other banks, commercial bank stress tests that need to just keep a little bit less in terms of overall capital for bank runs. But as a part of their stress tests, you used to have to use the cash on hand, cash stored at the Reserve Bank. And then they introduced that if you're holding bonds of certain classes, i.e. government bonds or highly rated corporate bonds, that you could basically count those as well, right? As towards your basically stress test and liquidity requirements. And so when you looked at the financials, the profit and loss and the balance sheets, and you looked at the stress tests, Silicon Valley Bank passed with great colours. So did Silver Lake, and so did Signature. And this is where we're going to get into a few things here. Now, when let's just put this. We're going to bring out the government now. I'm going to put the government maybe over here. This is where the government can go. Everybody, government can go over here. When the government came out and said, "Okay, everybody, you can hold not just 10-year bonds, everybody, but I'm just going to use the bond thing over there." They came out and said, all right, to help kind of, get people buying these bonds, because government wanted people buying bonds, and to kind of dampen the profit and loss swings on bonds, because bonds can go down in value and interest rates can affect, payouts. We've discussed this before. You can classify bonds into two different categories. One is available for sale, and the other ones are we're going to hold them to maturity and kind of amortizing the costs. And so what this did was on a profit and loss kind of statement for banks holding this, any losses that you've taken on the ones that you're holding to maturity, all right, and you're holding, so any losses that would actually have been there. So say if you're holding a 10-year bond, interest rates are rising, the actual, that bond is no longer worth what it was going to be worth in terms of, because it's, the yield will go. And usually you would, on traditional accounting practices, correct me if I'm wrong here, Arnie, then you would have to represent that loss, your change in position of that asset or that bond in your financials you've taken as a loss. Whereas if you held it for available for sale, it would show up in your profit and loss statement as we used to hold $21 billion worth of bonds. Those bonds are only worth $19 billion now, so we're going to show that up in our financials. Whereas if you were holding them to maturity to kind of help dampen this profit and loss swings, you wouldn't have to actually show them in there. Now that was okay up until a certain point, which was when deposits started going down and interest rates started to go up. Then you have to do something about those pesky losses on the on-hold to maturity bonds, okay? Especially if you're liquidating them, all right? So when you liquidate them, suddenly you have to do something. You have to show this money somewhere. Now, what would make you liquidate stuff? They were planning on holding this for 10 years. Now, I don't know why they were holding. I haven't found an Arnie, maybe you know, but I've watched about, 8 hours worth of different explanations on this. And not one person yet can explain why they were taking out 10 years over 1 year, 2 years, 3 years, 5 years, 6 months, when the rates weren't actually that much better on the 10 years. And so they're kind of tying up capital for no reason and putting themselves at more risk than what they would have with shorter term bonds. So I'm not sure the reason why. Do you have a reason? Do you have a hypothesis?
I'm not sure the reason why either. I mean, I would hypothesize or assume that those longer duration bonds are meant to be safer, and therefore perhaps as a form of tier one capital is viewed as a safer form of collateral or something along those lines. It also begs the question, if they even though they were told one thing by the Fed and the government that at first that interest rates weren't going to rise, and then it was clearly signaled that interest rates were going to rise. Why wasn't more of that interest rate risk hedged?
Yeah, so we're going to get into that one definitely.
Yeah.
No doubt about it. So, what we're going to do now is go, okay, well, this is the setup for the fall, everybody. And so, now when deposits have gone down, all right, and when people start taking out money and there's less deal activity to kind of top up more money, they'll need to start to sell some bonds. Okay, so this is pre the VCs getting together, so pre these guys getting together and colluding. One of the guys, Patrick Boyle, kind of summarized it the best, which is this is the first bank run organized on Slack. Slack, for those that don't know, it is like Teams. So there was an announcement by the bank in their financials announcing, I think it was about initially, I could be wrong on this, don't quote me, but it was around a $200 million loss of the first round of bonds that they had to sell, in which kind of uncovered to everybody that the bank was holding a whole bunch of bonds as hold to maturity that weren't properly priced onto their balance sheet. All right. So the first bit of like sniff that the bank might not be as sturdy as what the stress test made it out to be. Now, that is why I call these guys hawks of the financial industry. Basically, a whole bunch of CFOs from VCs got together last week and said, this smells, when it smells like a rat, it is a rat, generally speaking. And they told all of their startups, because these are their portfolio companies that they've invested into, please go and get your money out of Silicon Valley Bank. All right. So go get all your money out of Silicon Valley Bank. All right. Move this stuff up here, clean up a little bit. All right. So what does that mean? That means that Silicon Valley went, we've suddenly got $42 billion worth of bonds that we need to sell. Oh dear, because we've got lots of withdrawals. And then they sold those bonds, and suddenly to sell all those bonds, I think that the loss was around $2 billion, Arnie?
Yep.
Can you fact check that for me?
Yeah, but I think it's also like magnified depending on like what duration the bond was when they bought it.
Yeah, but all up, I'm just saying, I know there was about $42 billion worth of bonds sold, and there was a massive loss taken. Now, why is there a massive loss? So then there's like, wait a second, like, surely they saw that interest rates were going to go up, and they would have hedged against their bonds so that the loss wouldn't have been as big. That's what's supposed to happen. Enter the chief risk officer of Silicon Valley Bank, everybody. And the chief risk officer of Silicon Valley Bank actually left in, I'm going to say again, fact check me, March 2022. And Silicon Valley Bank
9 months. Did
not have a chief risk officer for 9 months.
So it was 1.8 billion for the quarter. So they sold 21 billion in bonds, resulting in an after-tax loss of 1.8 billion.
Thank you. So generally, when you have a chief risk officer, they'll look at where you're putting all your monies and stuff, and they'll work out a way, what your risks are, and then how to mitigate those risks. That's the whole point. And so they actually removed their hedging of their bonds against interest rates in early 2022. And when everyone thinks of interest rates, they probably only had one direction that interest rates were largely going to go in, and that was because of record lows. And that was that they're going to be going up. All right. So everyone kind of agreed that interest rates were going to go up. Now, chief risk officer, hedging removed, interest rates were going to go up.
What does that spell?
What does that spell? Okay, I'm going to use my favorite little GIF again. This little one, that spells this, everybody. Equals bad times. So after the bank had kind of more money then started getting, and so there was Australians flying out to the US. I saw on the news to try and get their money out of the bank. Silicon Valley Bank turned around and gave an old no cash here, chopper. No here, no cash. Right? And then that kind of led to I guess the share and the share of Silicon Valley Bank to be worth about that, and that's what you need to do with it. So you could say that the bank had a myriad of problems in both its choice in asset classes of investments, where it was tying up too much of its capital. It overstated its deposit growth. In summary, this is my summary of it. Arnie, you can kind of choose what you want, but there was some bumper years, 2021, early 2022, where there was record deposits coming into the bank. They couldn't lend it out fast enough. They needed to make money on it because they don't charge any fees, generally speaking, to open accounts and on services. So they kind of bought bonds with that. For some reason, the hypothesis is maybe those bonds were safer, but maybe not. A lot of people have been questioning kind of their decision around 10-year bonds. But they bought illiquid assets, or they bought assets that were going to come to term in 10 years. They weren't illiquid because you could sell them, but you're probably going to take them at a loss, especially in the current environment where interest rates were always going to go up. Inflation was already happening in 2021 and 2022. They got rid of their risk officer in 2022. They got rid of their hedging, which is the kind of hedge against interest rates going up, affected the bond price. So you kind of you stemmy the losses out. At some point, someone got a sniff of the kind of way that the accounting was being done within kind of the banking rules, though. But the VCs got a sniff of that. There was a bank run on the money that forced them to sell their bonds at a loss, take a loss, which caused a further bank run. And basically, that's all she wrote. Now, one last little bit of fun to put up on the board. So, bank went under on the 13th of March officially with the Fed, but really it's a Friday before that. So think about it as the 10th of March, everybody. And we have our kind of sale of shares. So the CEO sold 11% of shares on 27th of Feb. The general counsel 19th of Feb. 19% on the 5th of Feb. The CFO sold 32% of his holdings on the 27th of Feb. And the chief marketing officer sold 25% on the 1st of Feb. So
that's unbelievable, isn't it? Like
so within a month of Silicon Valley Bank going down, and it wasn't just like a quick thing, right? They knew a month ago that they had no hedging, they invested too much in bonds, that there was decrease in withdrawals, decrease in deal activity, increase in withdrawals from people. They couldn't meet it. Bang, bang, So we'll see what happens on that. But some really, really quick ones before any special commentary from the big arms and onto quickfire news is that reading into Silver Lake's, which we commented on last week's, where at the time a lot of the reporting was that it was crypto. Senator Warren was coming out with crypto. They actually looked at their assets. It was exactly the same reason.
Yeah.
It actually wasn't crypto because they're doing crypto. Don't get me wrong, they're doing crypto. But same reason where they had some small hedging, but they put a lot of their money into bonds. They didn't expect there to be withdrawals. There was a slight bank run, the liquidity crisis, because they're using the same hold to maturity versus for sale on the bonds. And they're holding nearly 100% to maturity, which was interesting. And then Signature Bank, again, I looked into it. It seems to be very, very similar to Silver Lake. And the CEO actually came out on Twitter, I don't know if you saw it, Arnie, saying that we're actually completely solvent. And the New York regulator took us over because of one thing and one thing only, to make a point, because we dealt with crypto.
Yeah, I saw that, and that's huge. That's like a huge allegation. So interesting to see what they do if they prove that. Interestingly, like I also started looking at a few of the other banks that when it occurred on the Friday, and then over that weekend, I was having a chat with some mates, and we were looking at balance sheets and things like that. Full nerd activity, just delving into it. And you're spot on. Like a lot of banks, regional banks in America, in the exact same boat. Interestingly, some of them, and you were touching on this in your explanation, which was great, by the way. Some of them actually do report in that held to maturity part of their financial statements. They do report what the the fair value is at that point in time. So if they're like, in a loss position, which wouldn't matter if they get to hold it to maturity, but it's, if they were forced to sell. So it's interesting to see that. And one of the ones which was
just good accounting practices, at least.
Oh yeah,
compared to Silicon Valley Bank where they don't have to and they didn't.
Yeah, well, that's why it sort of begs the question. I'm not an expert on American accounting standards or anything like that, but it mustn't be a requirement to disclose that fair value.
It isn't a requirement.
But some must do it just for peace of mind. And I was looking at First Republic actually, because First Republic, if you look at their balance sheet and some of the line items on their statements looked quite bad, but in the days either just prior or just after
they put some more information out there, eh?
Yeah, well, just prior to the regulator seizing control of Silicon Valley Bank, JP Morgan injected $70 billion into First Republic.
Yeah.
And that was just before the open, where it lost like 70% of its value in pre-market. And then on that day, I think it got down to about $17 a share. And if you had bought at the low, you could have been up over 100% by the close of that day, because it got to like 42. It's bouncing around, it's going up and down. But then, interestingly as well, like obviously the government came out and said we're going to back deposits for Silicon Valley Bank and Signature 100%, like fully, and then every other bank will have access to this, including those two, will have access to this facility, 25 billion, where you can swap out your, for lack of a better term, toxic bonds, and then get the new ones with the higher yield. But there was certain requirements around the bonds or the mortgage-backed securities, and I think First Republic wasn't eligible with what they were holding. So that might go to that point about why they had the 10 years. Perhaps there's something to do with. I mean, that facility is a recent thing, but maybe there's some regulatory thing which is about what asset class you're holding. But interesting environment at the moment.
Yeah, it is. Well, I mean, first, like I said, I bank with First Republic, and that's who Hammertick banks with. So it's always interesting seeing your bank up in the news. I'm going to tell you, it doesn't make you feel. So I'm going to send money over there to like pay off my credit card, to still use my US credit card, and I'm like, do I send the money? Do I not send the money? Well, do I send the money and they go under? Damn it!
Maybe you should be spending up on that, mate.
All right. Quick fire.
Yeah, quick fire, rapid news items. And if we missed anything, Tankers, just get at us with a question, because it's a complex, interesting topic. Yes. But yeah, there's still more to come from that. So, all right, here's the rapid fire, Braddles, and some of it we might have already covered. Goldman Sachs has bought SVB's bond portfolio. TikTok is considering splitting from ByteDance if the deal with the US fails. Putin has said that the Nord Stream attack was committed at a state level. That's huge news. He has also said there's a possibility for, like in theory, to repair Nord Stream. And that
if it's at a state level, then he's discrediting what happened, where you had obviously the famous whistleblower come out saying that it was the US and CIA, and then you have the US come out and say, actually, no, it was a Ukrainian, terrorist squad or whatever it was.
Yeah.
And then you had Germany come out and back up what the US said. And then you have Russia coming out saying, no, it was at a state level, because a bunch of other countries started coming out saying it couldn't have been Ukraine because they didn't have the...
No, I think he means like, when he says state level, I think he means it was done by a country. I think that's what he means in terms of like state.
Yeah, but what America came out and said wasn't done by necessarily. They said that Zelensky and that didn't know anything. And it was done by if you look at the words, he says Zelensky doesn't know anything. It's done by a Ukrainian kind of...
Yeah. This is Putin rebutting that, saying
that's what
it wasn't a terrorist group. It's one of you governments. I don't know which one. It's done at a state level. So he's saying, and I don't know, he didn't elaborate on that. He also said in this same spiel that he thinks there's still a future for Nord Streams, which is interesting as well.
Sorry,
I know you have a laugh, but what else is he going to say? S&P has downgraded First Republic Bank to credit watch negative. So I saw a funny Patrick Boyle tweet over the weekend where Moody's downgraded SVB or something, and he was like, "Oh, that's good timing. Thanks for letting us know." Well after.
Which is always what they do. It's well because they don't actually pick up on the risk. As soon as the risk is uncovered, then they re-rate everyone against that risk.
It's a funny old system. Let's let's not go into that right now. That's a box. That's a can of worms.
Hole, deep hole.
So hedge funds have been stung from this bond market fallout from the Silicon Valley Bank collapse. So yeah, hedge funds are feeling the pinch as well because of this. The SVB failure, executive trading that you just showed before, is being investigated by the Department of Justice and the SEC. So they're already on the chopping block for that. Other news, chip stocks are on a tear. So amid a broader market rally, I mean, not today, not the last couple of days, but over the last sort of week and a bit, Intel's is up, AMD's up a fair bit. Nvidia continues to go to highs. I don't know if it's all-time highs. I think it might be. Qualcomm and Micron also up. So yeah, chip stocks are rallying in this environment. Meta.
I can't say my portfolio running at the moment.
I don't know. Well, I do own some Intel, but they're heavy bags still. So if it could rally a little bit more, that'd be great. Meta's have cut 10,000 jobs, and I believe they've already. This is the second round of cuts for Meta.
Oh, wow, this is on top of the 11,000.
Yeah, this is another 10,000. So they've already started, or they might have already done it, but started this second cut. So and Meta stock is on an absolute tear as well from the lows a couple of months ago when it got to like 80 or 90. I think it just cracked 200 recently.
I remember a certain Arnie that mentioned at the lows back in November-ish.
I bought some. Not financial advice, but yeah.
What'd you get in at?
It was below 100, not at the exact low. I didn't. Yeah, but it was
nicely played, Arnie. Nicely played.
Yeah, thanks, mate. I think that one was was weird that it got to so low.
You made the call. You made the call.
Yeah, it was. I think this is speculative, and again, we're always general in nature at Money in the Tank. But I feel like the inevitable space that will be played in is VR, AR, and obviously Meta's not the only player in that space, but it feels to me like they're the most advanced player. So it's just like an interesting bet on a company with really good existing fundamentals and good products, and a really good moonshot for the next generation of.
It kind of helps when you have $100 billion support.
Oh yeah, absolutely. and this is my last item. And I think this one's controversial, so I left it for last because I want to see what you think about this. Elizabeth Warren on the SVB and Signature Bank says Fed Chair Powell's actions have directly contributed to these bank failures. So she's laying it at Fed Chair Powell's feet. She didn't say the full committee.
So I think it's controversial that the full committee versus Jay Powell, because he is just one, right? Of a committee that votes, obviously holds a lot more power than the other ones, but so be it. He's still independently voted, right, within the committee. Same as the Reserve Bank here. Where I don't know if it's the Fed's fault or banking. I'd say banking's fault. Similar to here in Australia, I've been thinking about this a little bit lately. Similar to here in Australia, where banks on loans generally add 300 basis points, or I think it was 300 basis points, and they're thinking about putting it down, and they've kind of left it at about 300 basis points on top of whatever rate it is at the moment to work out your stress test of your loan. Yeah. When the Fed's raising rates by 300 basis points in a year, it kind of, and they've got knowledge of that ahead, right? I think in America it's less than 300 basis points, to be honest. I think it's about 200, 250. So if they know that it's that, raising the rates that much in a year, they know the ramifications that are going to be coming from that. And the pressures that's going to be putting on things. The Fed is supposed to also know things like, okay, if all the banks, how much, they'll have numbers around what are the total amount of bonds that people are holding. If we go 300 basis points this year, what's that going to do to all the bonds, and what's that going to do to the stress test of the balance sheets and the rest of it? So I think it's just the speed in which the rate rises have occurred against the information that the Fed should know and basic economists should know, right? I've been out there as a proponent of raising rates fast, right? So I'm not going to try and backpedal or anything like that. But I would say that before all this, my kind of understanding of more so I didn't know that banks could hold bonds in place of cash, and then you could hold them at hold to life so that they don't have to show the swings and roundabouts. Like that level of detail is something I didn't know until now. But that's something that the government and the Fed should know.
I feel like the Fed. I don't think the Fed would have that. Like maybe they will in future, but that level of granular detail is.
And
probably...
that's the thing. So that's where like you go. Okay, should have they known? Yes. As in, should have they known? Yes. But is it within reason for them to know every single little thing? No. That's where they take the learnings, and the next time they do better, right? And that's look. Warren just goes after things, and this is the other thing. Like she was going, oh, Silver Lake, you went under because of crypto. You know, it was always going to be. You know, it was always going to be crypto. You know, you're basically a pack of like jackasses, blah blah blah. And look, she's just a sob story. I didn't like her when I lived in America, and I still don't like her. But look, I can't deny that the Fed is part to play. But whether it's not their responsibility of knowing every single fact, you want them to know every single fact and rule. But I mean, it's nearly impossible. Anyway,
I agree with you. I'll play devil's advocate here a little bit because, you know, just prior to the Fed signaling that they were going to raise rates, raise them hard, hold them there for a long time. And on that journey, the Fed and Jay Powell have been criticized for being like flip-flopping between hawkish and dovish statements until Jackson Hole, where he was decisively hawkish and was like, this is happening. But that's almost 12 months on from when they initially started signaling they were hiking. And this is coming off the back of the narrative that they were pushing all throughout the start of 2020, 2021, that inflation was transitory and they wouldn't need to hike. So, you know, it's hard to have trust in the Fed when they've had these missteps the whole way along and these bungles. Do I think that raising...
Sorry, transitory, then soft landing.
Yeah, exactly.
I was going to have this discussion last night. Is it like... how much trust is there when someone's like, it's transitory now? Okay, no, it's going to be a soft landing. Then, oh no.
Now we've got to raise rates at the fastest pace in history, you know. So, but you and I and Jolie have agreed for a long while that, I mean, I think we were ringing the bell on this even before they started raising rates, saying inflation's a problem and it's going to occur.
I was March 2021. You were neutral and Joel was against.
Well, actually, I think.
And then I played the episode. Then only by April, May, you were like, needs to happen. Jolie was like, needs to happen, but we're probably going to go slowly. And then about a month later, so about mid-2021, we're all...
I don't mean on the course of action. I mean, I think there was even a very early episode, perhaps like around... don't fact check me, but an early episode in Money in the Tank history, we were talking about inflation and like, this is going to occur. We didn't have a position on, you know, how they should address it.
But I mean, we started having a position in March 21. Yeah. So that's a long time ago.
Well, yeah, it was
2 years ago.
yeah, exactly. So it's interesting, and I also think like this is sort of branching off onto another discussion here. Maybe we could address this in another pod. But you know, should SVB have been bailed out? Should those companies that bank with them and
look, that's a good discussion because it's. I don't believe the company, so I think the executives shouldn't have got any money and left. They should have been out of paying out bonuses 20 minutes before they got shut down. The people that own the stock of SVB lost. The people that like own bonds of SVB lost. Depositors, though, I'm a big fan of depositors. Now they should have spread their risk, yes. But the contagion, if you let 3,500 or 4,500 startups in your country go under because of who they chose to deposit their money with. Yes, you could say, oh well, bad luck. The risk to like FRB or like all the rest of the banks gone, the run on their money, you basically kill the startup industry and the startup industry in America is their most, I would say, nearly treasured asset. You had people coming out saying these 1,500 climate change startups that are funded, that if you let Silicon Valley Bank go, it's going to impact climate change. I mean, you know, some of it's a bit like, oh, come on, get a violin out. But some of it has some truth to it. You got 1,500 guys working on carbon capture that are gone. So I don't know. Anyway, we're going to wrap this one up.
Yeah,
sorry,
we'll mark it down as a debate topic in future because I like that one as well. And for what it's worth, I agree with you. So 50-50 time, all right?
Yeah.
So round one AFL this week, and we've got a big clash on Friday night. Your mob, the Pies, Collingwood versus Geelong Cats. Yeah, your mob. The Geelong Cats, so, you know, last year's premiers. Maybe it's a bit silly me asking you about your own club, but objectively, what do you think your chances are, Collingwood or the Cats on Friday night? Mate, who are you tipping?
You have to go your own club. I don't care. It's Collingwood all the way.
Yeah. I actually am tipping Collingwood as well, because I feel like the Cats are this weird anomaly last year where I don't know how they bloody won a flag with the squad they've got and how aged their list was, but I'm banking on the loss of Selwood at the captaincy spot being a huge blow to the Catters, and I think the Pies demonstrated some really good gutsy football last year. It's an exciting football, so I
It's
want that to
scary though.
continue. Oh
It's
yeah,
scary because you don't know if that was also a aberration, like it was just a freak thing for one season. The Pies is kind of getting over the line, getting over the line, getting over the line, getting over
yeah.
grinding. You don't know if that's like their brand of football, or if that was just a year where you kind of followed on game to game to game, and if they get smashed out of the park this round, they don't get on that ball. But hey,
Well, it
we'll
was a
see what
huge
happens.
improvement from the year before, but I'm hoping that they continue that exciting
Go
style of football.
Pies, go
Yeah,
Pies,
go the
hot,
Pies.
hot Pies. All right. Hope
That's
you
it.
enjoyed the episode, guys.
Yep. See you later. Have a good week, all.
Peace out.